Okay, today we are diving into one of the most provocative suggestions we've really seen coming out of a major Wall Street firm. The idea, it's simple but kind of radical. Disney should deliberately, maybe immediately, shut down ABC, their 82-year-old broadcast network.
Yeah, it's called the Disney ABC shutdown thesis. Came from Needham and Company, analyst Laura Martin leading that. And what's really striking here is how it's all grounded in, just the hard financial math. They're saying Disney should ditch this historic cash-flowing asset, not because it's losing money necessarily, but because keeping it is actually costing them potential shareholder value. A lot of it, like a staggering $20 billion.
Wow.
We're going to break down exactly how this pretty dramatic exit is supposed to eliminate regulatory risk and, well, unlock growth.
$20 billion. That is a number that just makes you stop and really pay attention, tied to just closing the doors. So let's unpack this. This isn't just about, streamlining things. It's very specific about how they should get rid of it. Needham's thesis is really clear. Shut ABC down. Do not sell it.
Right. And that difference, shut down versus sell, that's the absolute key here.
Yeah.
It's why Martin's, frankly, deep analysis is getting so much attention. She's not just looking at the profit and loss sheet. She's factoring in these sort of systemic external costs. So the shutdown strategy, it does two main things at once for Disney shareholders. First, and this is critical, it lets them get rid of those persistent and frankly expensive federal regulatory risks, the ones tied to holding broadcast licenses.
Right, the bureaucratic burden, the cost of just dealing with the rules.
Exactly. And second, by just removing this business unit that's structurally challenged, Disney can immediately unlock higher valuation multiples on Wall Street. They basically get to show a cleaner, faster-growing financial story, one that's focused only on their unregulated stuff, streaming, parks, studios.
Okay, so if they shut down ABC, what happens to the actual shows? Grey's Anatomy, Good Morning America, that content doesn't just, poof, disappear.
Right. No, not at all. And the recommendation here is actually quite brilliant in how simple it is. Just simulcast all that ABC broadcast content, the news, the dramas, Late Night Nick, put it all onto Hulu. Or even just the existing ABC app. See, Hulu is purely digital. It's an unregulated platform. It already has a huge growing audience. So Disney keeps the programming value, maybe even enhances it for a younger audience, but without all that constant administrative and regulatory drag that comes with the traditional broadcast licenses.
Okay, right. Let's jump into the nuts and bolts of the financial calculation then, because that $20 billion number, that's the real hook. Where does that huge value creation actually come from?
So the analysis calculates that shutting down ABC could boost Disney's shareholder value by that estimated $20 billion. And just to put that in perspective for you, Disney's market cap right now is what, around $203 billion? So this move potentially could add about 10% to the value of the entire company, pretty much overnight.
Okay. And the main reason for that, the driving force, is what Needham calls structural drag. Can you talk us through what that actually means in practical terms?
Yes, structural drag. Think of it like having a huge, heavy anchor tied to your fastest speedboat. That's kind of what ABC is becoming for Disney. It's a structurally shrinking asset. It's losing somewhere between 5% and 11% of its revenues every single year. And that's not just, lost ad revenue. It's also declining affiliate fees the money cable companies pay to carry the channel. Plus, there's a cost of just maintaining the physical infrastructure, the tech, for dozens of local broadcast stations all across the country.
So even if the rest of Disney is doing great, parks are packed, Disney Plus is growing, ABC is actively pulling down the total reported growth rate for the whole company.
Precisely. Let's say the experiences division, studios and streaming combined. Maybe they're growing at a healthy 5% year over year. Well, the losses, or the shrinkage, from ABC might drag that overall reported growth rate down to, say, 4.5%. Now, that half a percentage point, it might not sound like a huge deal to an ordinary person, but for Wall Street investors, it changes everything.
Okay, and this is where we need to talk about multiple expansion, because that 0.5% difference, that's apparently where this $20 billion is hiding. Can you break down what multiple expansion really is and why Wall Street values that growth so, exponentially?
Sure. Think of it like this. Wall Street assigns a value multiplier, often a price to earnings, or PE ratio to Disney. It's based on how fast they expect Disney's earnings or revenues to grow in the future. They value a dollar that's expected to grow by 5%, much, much more than a dollar expected to grow by only 4.5%. It implies a more dynamic future. So when Disney gets rid of the shrinking asset ABC, the remaining company suddenly shows a higher, cleaner reported revenue growth rate. Martin projects this could boost it by 40 to 60 basis points. That's 0.4 to 0.6% consistently over the next decade.
Wait, 40 to 60 basis points? That's still less than 1 percentage point difference? How does that tiny sounding shift translate into billions of dollars?
Because that higher growth rate isn't just applied to ABC's old revenue. It's applied to the entire remaining company's massive revenue stream. That sustained increase in expected growth convinces investors that Disney isn't this troubled legacy media company anymore. Instead, it's a pure growth story focused on streaming and experiences. And this shift in perception results in the market assigning a higher valuation multiplier. The multiple literally expands. And that expansion, when you apply it across hundreds of billions in revenue, that's what generates the vast majority of that $20 billion gain for shareholders. It's kind of a reward for becoming a pure growth investment.
But hang on, just closing down an operation this big, this historic, that can't be free, can it? Surely they have to take a massive financial hit, a write-off. How does potentially an $11 billion loss somehow turn into a $20 billion gain?
That's a really good question. And it gets to how Wall Street, the sophisticated analysts, view these kinds of big restructuring moves. Yes, there's a one-time financial hit. The write-off needed for closing ABC is estimated at somewhere between $10 and $11 billion. That's roughly 5% of Disney's current market cap. It's not small. However, Wall Street accountants, the analysts, they're very used to seeing this kind of thing.
So they don't penalize the company for it long term, they sort of look past it.
Pretty much, yeah. They'd likely categorize this under discontinued operations. It's an accounting designation that basically walls off that past loss from the company's future potential. It allows investors to focus on the healthier, faster-growing business model that's left behind. They often treat the write-off as a one-time, non-recurring item that doesn't reflect the ongoing health of the business. So that immediate negative accounting hit is seen as outweighed by the decade of benefits, the multiple expansion, the savings from regulatory costs they expect to get going forward.
Okay, so the math makes sense then. The long-term gain from higher growth and lower costs outweighs the short-term write-off pain. But if they're doing this anyway, why not try to sell the network, even for, I don't know, a few $1 billion to a local station group or something, get some value back? This is where Needham really pivots from accounting to, well, avoidance, avoiding the real costs of operating in that regulated broadcast world.
Exactly right. The absolute key to unlocking that $20 billion, according to this thesis, is that the value gained by avoiding the whole regulatory mess is actually greater than any potential sales price they might get. The core risk, the big problem with selling ABC, is that any transfer of those broadcast licenses requires specific approval, consent from the Federal Communications Commission, the FCC.
And what's so hard about dealing with the FCC that it justifies just walking away with nothing, receiving zero salvage value?
Well, it introduces huge amounts of time delay, administrative burden, and maybe most importantly, political volatility into the whole process. Just look at recent history. Remember when Paramount wanted to sell a much smaller group of local TV stations? That deal took 14 months. 14 months to finalize, and involved navigating this incredibly complex, politically charged regulatory landscape.
Wow, nearly a year and a half just tied up in red tape for a relatively small deal.
Yeah, and the cost, both direct and indirect, of navigating that environment just becomes enormous. Needham's arguing that Disney's operating in the super fast-moving, generative AI world, as they put it. Agility is everything. The ability to react quickly, pivot assets, that's paramount. Getting stuck in 14 months of regulatory bureaucracy, that's like a death sentence for agility in today's market. So shutting down, while it sounds extreme, seems the only way to completely sidestep having to ask the FCC for anything at all.
It's really a strategy driven more by risk management than by maximizing immediate cash from a sale. And we have seen some specific examples recently, haven't we, of just the sheer cost and hassle involved in holding these broadcast licenses.
Oh, absolutely. The licenses don't just come with rules. They come with significant legal and political exposure. Things that pure streaming platforms just don't face in quite the same way. I mean, think about that controversy that blew up around Jimmy Kimmel's show suspension. Remember the comments about the assassination of Charlie Kirk? That whole thing led to public outcry, threats of an FCC investigation. It raised really big questions about regulatory authority over content on broadcast.
And this kind of volatility often translates into actual dollars lost, doesn't it?
It really does.
Yeah.
The pressure to maintain a certain kind of political neutrality, or at least avoid major legal fights when you operate under a federal license, it's expensive. We saw ABC previously pay out $15 million. That was to settle a defamation suit linked to comments George Stephanopoulos made regarding the E. Jean Carroll case and Donald Trump. So these legal costs, the settlements, managing the political risk, the potential for huge federal fines, Needham basically views all of that as an excessive, ongoing, and crucially, entirely avoidable tax, a tax being levied on a business that's already shrinking.
Okay, yeah, that really crystallizes why the non-sale shutdown starts to look like the optimal financial path.
Yeah.
You get the upside from the multiple expansion, you save money by ditching the regulatory tax, and you avoid getting bogged down in this massive administrative ordeal of trying to sell it.
And let's not forget about the actual asset itself, the state of ABC today. The performance numbers really underscore why such a drastic action might be considered. Across both broadcast and cable viewing, ABC only averaged about 2.4 million primetime viewers. That was during the summer of 2025.
2.4 million. And I bet that viewership isn't exactly the demographic that advertisers are clamoring for these days.
You bet correctly. The demographics are frankly toxic if you're an advertiser trying to reach young, digitally savvy consumers. The median age for a traditional ABC viewer is up there at 58 years old. 58. Now, compare that to Hulu, the platform they'd likely shift the content to. The average viewer age on Hulu is 37.
Wow, that's a 21-year age gap. That is massive. So moving the content to Hulu, it essentially keeps the valuable shows, the IP, alive, but puts it in front of a much more valuable audience for advertisers, maximizes the ad potential per eyeball, basically, all while dodging the FCC. It really does sound like a trifecta of financial benefits.
It kind of is when you lay it out like that. The audience shift creates the underlying problem, right? And then the restrictive regulation acts like handcuffs, stopping Disney from reacting effectively to that shift. Now, look, we absolutely have to acknowledge the counter-argument here. There is one. And it mostly centers on live sports. Live sports programming on TV still drives a lot of advertising revenue and, maybe more importantly, those affiliate fees from cable companies.
Right. Sports is often called the last sort of pillar holding up traditional linear television.
It really is. Paul Verna, he's another media analyst, he points this out. While the structural problems for ABC are definitely real, ABC's role in bundling sports rights, especially with ESPN, still gives Disney significant negotiation leverage with distributors. So, an immediate shutdown. It might be complicated by how it impacts their bigger sports strategy. It's not quite as simple as just flipping a switch.
Fair point.
But the broader idea here from Needham that a huge iconic legacy network could actually be worth more dead than alive because of these issues, that has implications far beyond just Disney, doesn't it? This exact same regulatory drag, this structural shrinking. It's got to be creating volatility across the entire linear TV sector. Oh, absolutely. This thesis isn't really just about ABC in isolation. It's like a warning shot fired across the bow of every single legacy broadcast company out there. You know, think CBS, which is owned by Paramount. Think about the networks owned by Comcast. If Wall Street starts to believe that a shrinking network is just creating massive political risk, legal headaches, and dragging down overall growth, they will universally see value in getting rid of it, removing that drag, regardless of how many decades of history it has.
Okay, so let's try to summarize the key takeaway for you, the listener, from this deep dive. Disney's clearest path, at least according to Needham's analysis, to potentially adding $20 billion in shareholder value involves this really radical non-sale shutdown strategy for ABC. The financial logic is all about eliminating that regulatory drag and unlocking the hidden growth potential of their core businesses, streaming and parks experiences.
Right. And this really raises a crucial and I think pretty provocative thought for you to consider as you watch the space going forward. We already know Disney is moving to increase prices, right? On its ad-free Disney Plus tiers. That's a move clearly aimed at getting more revenue from their wealthiest customers, partly to offset these worsening economics in linear TV. So if the core broadcast network, ABC, is potentially disposable, seen as more valuable, shut down because of its volatility and poor growth, what does that imply for the long-term future of their other, arguably much more valuable, linear asset, ESPN? Especially as the entire industry keeps pivoting faster and faster towards pure streaming. The question maybe shifts from if Disney will eventually take ESPN fully online, fully direct-to-consumer, to when, and maybe what regulatory cost structure they'll choose to avoid next time.